Hello, everyone. Welcome to the month of October. Thank you for joining us. Pablo Marul here alongside Jacob Chaparro. This is Zenith's market update for this month. 4 topics that we want to discuss, more of the personal finance side. Of course, we want to address how the market has been very volatile since last month and where do we see this potentially ending? How do we finish out the year? Before we get started, I would like to encourage you to please subscribe to our channel, leave us a comment, definitely give us a like. We always want to hear from you and are motivated when we hear the things that you want to discuss here. So with that being said, Pablo, good day to you. How's it going on your side of the country?
Very well. So far, we are getting the spring here. And so weather is much better. And so we're ready to go out more often. And also cases are much lower. That's good also, COVID cases.
That's excellent. Well, I know you've been working hard on some of the first topic that we'll talk about that I think is very prudent to discuss as we start to finally see the end of the year. And there's some really good data that came out. So without further ado, Pablo, lead us into our first topic.
Yeah, well, basically, the Fed just came with a new data about net worth in the US. And amazingly, it has increased to $142 trillion. Basically, helped by the higher value in the equity market, which add $3.5 trillion, and also real estate. What surprised me of this data of the Fed, which compared the Q2 of this year relative to Q1, is how much has increased relative to the pre-pandemic. The net worth has increased 28% before the pandemic to today, which is amazing, no? And clearly is helped by a lower interest rate, which help a higher market value in equities, and also a lower interest rate. It means potential borrowing more money so you can bid for a higher house. So that's important. And lastly, this is important too for everyone. There is a $10 trillion in savings accounts. That data was interesting.
Yeah. Part of the reason we want to get this out to everyone is we've heard throughout this year, should I buy a home? We have been pro homes, at least for our clients and the people that have asked us. There's a lot of wealth there in our eyes to retain and to achieve. But the stock market too, we talked about in the last market update that although we've retracted some, we're still right around 100% return from a recovery since last year. Think about that, 100%. So there has been a lot of wealth that has been generated. Needless to say, people are starting to question whether that continues to propel forward, whether it be real estate, whether it be the stock market. And I think you're starting to finally see, as a whole, the market starting to also understand that. So it's important how that dynamic plays into your own specific situation. Hopefully, you've captured some of that momentum to increase your net worth. And for those that are listening, that if you haven't, this is a great time to assess, your portfolio, your net worth, your assets, and see where the opportunity is going to lie here in the next coming year so that you can capture, some of this wealth here. We bring this up too because the Federal Reserve has announced that they're very likely to start to increase interest rates. So, Pablo, can you tell us more about what that means to the everyday consumer, average American household? When the Fed increases rates, what typical changes can one expect and how that impacts their own net worth, their own wealth?
Well, consumers, they will see that the interest rate in their credit card, it might increase. And also, if the 10-year rate increase, that's going to affect the interest rate that they will pay in mortgage loans.
Yeah, and what was the number that you said about the amount of savings right now across the country?
Yeah, 10 trillion in savings accounts. It's a lot of money. So you think that people they might feel wealthier. No, the stock market is going up. Their investment accounts, their house is valued more than before. So basically, your overall net worth is greater, and you feel much better. So and then you have money in the savings account. So it seems like there is a lot of tailwind for the economy as well. No.
Sure. And I would agree with that. The reality is we just got done with an actual recession last year. This is the beginning of a new economic cycle. And of course, there's challenges. Of course, there's going to be speed bumps. But if you look at history, we're well positioned for maybe some very fruitful coming years. But it is extremely important to understand where we're at, because sometimes it's more pull than take. I go back to the Fed raising rates. We've heard this a lot with our clients is, what do I do right now with my savings account? Because it's not getting me anything. The good news about the Fed raising rates is that you can expect more interest to be gained in your money markets, your savings account. The not so good news is that it is going to cost more to finance money. Mortgages are going to go up. All lines of credits are going to go up. So something there to keep an eye out how this progresses. I want to talk about something very specific that happened to a bulk of our clients that we focus on in terms of how do I best efficiently grow my wealth. And with the explosion in the stock market, a lot of stocks have really captured triple digit returns, if not more, since last March. If you have a company stock plan, you've likely have seen some huge gains. So I want to share a story that will allow us to really share a overlooked but yet very crucial aspect to your wealth if you have an employee stock option plan and if you have seen your company stock explode. I'll start by kind of giving a little history lesson, if you will, of your 401k, because that's really where most people's wealth is, besides their home, of course. 401ks weren't really a thing up until the 80s. If you look at the way in which the average American saved for retirement, it was through their employer, it was through pension. So the dynamic has changed a lot. You fast forward to today, a lot of corporations don't have pensions anymore. The ones that do are trying to get them off their books. It's a different game now, right, Pablo? The pension world opposed to the 401k, it's very different. The ownership now lies within the actual employee.
Totally. And they had to make their decisions related to their wealth before this decision was removed from them and it was made by the company. Now they have the responsibility to have this personal decision, and it will depend if having a great retirement or not that great or average retirement. So the concentration of risk is very important.
Yes, and we want to tie that together with the graphs that we've shown you of how net worth has exploded, and we peel the layers to that. Housing's been a big part of that. And if you are again tuning in, I hope your ears pricked up. If you have an employee stock plan, please pay attention closely because this is likely you. The appreciation of the stock has exploded. If you look at your own specific portfolio, you may very well find that maybe 1, 2, 3, maybe just one stock in your overall investable portfolio has really taken over a lot of the overall investable assets that you have. And this is very common when you look at folks that, again, are exposed to these employee stock option plans where they're granted stock shares, they can participate in that. It's great that we have the ability to gain that wealth on paper, but as that's progressed, so has your risk. And I go back to understanding how people are now expected employees to be responsible. Most of them don't. Most of them, that's why we're here. And any other advisor is to guide them through that. But the big risk is this. If you have a single stock, in particular, your company stock, which tends to be more of the norm, you're really starting to depend on one company and one company alone for your wealth, for your retirement. That can be a big, big trap down the road for your actual phase of income when you retire. Because as Pablo said, yes, you're able to get the gains, you're able to grow your portfolio. There's more risk that's involved with that. So I have this phrase that I've coined, and that phrase is pension-ized. And the question you have to ask yourself is, Is your 401k, your retirement, pensionized? And what we mean by that is, has a singular stock started to take over your portfolio with all this growth that we've had? And it's important to look at, because if you think about going back 50 years ago, when you relied on one company to provide you your retirement pension, and you fast forward to the dynamic now where it's your responsibility as the employee, and you have 50%, 30%, 70% of one company, your company stock, it's really not that different. You're still depending on one company to provide you that retirement.
Jacob, how you have many clients, or some of the solutions that you have provide to some of your clients?
Yeah, excellent. So the solution is very custom to everyone, because some of the things, besides the emotional piece, you have your company stock, you have allegiance and loyalty to your company. The other side to it is it costs money. It costs taxes sometimes to get less exposure in that. That's probably another episode. It's very important right now to assess and sit down with your advisor. I know that's what we're doing with a lot of our clients, and we've taken action on that because we want to take into consideration your exposure risk. We want to take into consideration your tax liability risk. We want to take into consideration your overall diversification score and sum things up so that we know what your overall retirement projection is looking like. Higher valuation in stocks does not mean safer retirement. Oftentimes it means the opposite. And I think that right there is the question where most people don't ask themselves. And we're asking our clients, we're forcing them to ask themselves that question right now and build a custom plan for them to, yes, find a median between capturing a lot of these returns, but simply not putting themselves in danger of pensionizing their retirement.
That's a good term.
We're going to take a break here. We have two other topics to discuss. Of course, our market expectation for the rest of the month and the year, as well as a very special segment about October, which is earnings season here. So stick around here. We'll be right back. Welcome back. We have two short topics here that we want to accomplish before we get to our market expectations and observations, some of the sectors that we like, dislike. Pablo, you have some things to share in terms of earnings season, as we are in the first month of the quarter. Is looking like it's going to be a kind of different earnings season in comparison to the ones we've had this year.
Yes, well, as our viewers can see in the second graph, and they can see on the right, basically, for Q3 that is coming next week, it's going to start next week, you have more companies that they are issuing earnings, upward earnings, so more positive earnings, which is good because that's going to help the market as well. Actually, it's 54% of the company have issued positive upward revision for earnings. That's higher than the average that in general is 39%. So this is important for you. It's just to know that so far is positive. Some of the sector that they are issuing higher earnings are material, energy, communication, and tech or information technology. Also, the earning growth year over year for this quarter is 27%, which is greater than the average of the past year, which is around 11%. So that's good also. There is more potential for higher earnings. Revenue growth also year to year, Q3 of this year to Q3 from the last year is around 14%. So that's greater than the past 5 years, which is almost 4%. So that's great also, good news. And lastly is net profit. And this is important. So far the expected net profit is 12%. In the past 5 years has been around 11%. And the other part, many companies are issuing warnings about higher costs. So we will see in this earnings season how much is this higher cost or bottleneck supply chain that many companies and many sectors in the economy are starting to see.
We can reference some of these charts once more here, but in terms of people's IRAs and 401ks, when we talk about earnings season and some of the observations you just pointed out, what would be something applicable to them to understand how earnings season works, and overall, why is it important to keep track of during months of January, April, July, and now October?
Well, definitely, companies tend to move, the price of a company tend to move with the earning growth, the potential earning growth. So the higher earnings in the future mean that higher value for companies. So that will translate in higher value for your 401k, higher value for your invest brokerage account, any or other retirement account that you have.
Yes, things obviously are looking pretty good when you look at. We don't want to paint rosy colored picture here, because Pablo said one of the big challenges right now that is out in the open, which we can transition into our last topic and talk about expectations. Supply chain has been a big topic of discussion around this earnings season, which really should kick off here in about a week or so with the major banks reporting. To simplify that, what that really means is companies are relying on obviously labor and transportation to produce their goods and services. Therefore, they can obviously return a profit and ultimately increase their actual price and shares of their company, their valuation. So with COVID right now, the lack of labor that's been going on, right now the challenges of the workforce, unemployment is still relatively high to what the norm or the expectation should be. There is a lot of challenges that are being presented, and I'll single out a company that just came out this past month and said, hey, you know what? Maybe things aren't as good as maybe what people were expecting. That company was Nike. If you look at it, I encourage you and invite you to look at how it's performed this past month. Has not been good. We find ourselves here in a very uncertain window of time. And I got to credit our team for kind of circling this window of time during the year as our expectation. If you go back to previous market updates dating back at the beginning of the year, our expectation was right around October, right around September to have some volatility. And here we are. Some of the risks here that we see right now are the supply chain issues. Rising oil prices have been really on a tear. Energy as a whole, as a sector, really prospered the first couple months of the year. And from there, it really has been going nowhere, at a sharp sell-off. If you look at that specific sector now, it is extremely fruitful. It has been. With rising oil prices, that does present challenges to other companies because it costs more money to obviously operate. Higher labor costs, as we talked about. I know the big thing that we also produced a video on was Evergrande company out in China, the real estate developer, how they have $300 billion in debt. Lots of risks that are out in the open right now. And before we get into projections, expectations, Pablo, I don't know if you had anything else to add in terms of the opposite side of the coin. You know, what potential traps are out there, and specifically what investors can potentially do to make sure that they stay disciplined, which is extremely important during this time.
Well, just for information of our investors, they will start to hear a lot this term stagflation. Basically, it's kind of slow growth combined with inflation. No, so probably inflation they are starting to see. Basically, when the company they cannot find a cheap or suppliers that they deliver on time, or their worker, they cannot find workers, so that's delay their production. So that's going to reduce the number of things that they produce, and that's going to slow the economy. So that's kind of major risk for the next 2-3 months. But basically, we have been good in at least kind of warning people that we might have some correction or equity sell-off. We will see how things evolve in the next month or at the end of the year.
And there's still a little less than 3 months at the end of the year. So here's where we stand, and here's the final takeaway in this market update. Currently, right now, we're at about 6% from the market high. If you recall from our last episode, we talked about when the market starts to go down, the difference between a sell-off, a correction, a bear market. We're very much at risk of being exposed and going through a correction, which would be a 10% sell-off from the high. That's what we're really looking at in terms of Zenith's guidance. Where we potentially see a bottom, definitely be a lot more observant in the coming weeks here But here's one thing to put everyone at ease that we want to get ahead of, be open about discussing. And that is that we also do believe that in this month, we are going to have the market bottom, at least for now. We do see November starting to be more fruitful. We do see that the market starts to rebound in November and well into December. For now, that's our guidance. Obviously, next month, we'll keep you updated to see if that has changed. But the good news is that on our side, we do see that we should find some bottom here in the coming couple weeks here. I do expect more pain, probably around that 10% mark, maybe a little bit more, to be kind of definitive low to the market. So for those that are not being proactive with their accounts, that don't have an advisor, stay invested, stay disciplined, look at things from a long-term perspective. For our clients, hopefully you are well assured and confident that we're doing that on your behalf. And for those in between, if you're wondering, should I consult with someone? Should I keep trading on my own? My 401k, don't proactively management. Of course, please contact us. You can reach us at www.zenithim.com, or feel free to pick up the phone and send us a text or a call at 858-716-7500. Pablo, thank you for your time. We encourage everyone, of course, to subscribe, and please like our channel. It gives us the ability to continue to deliver you really great content. Pablo, any last guidance or words for our viewers this month?
No, basically, we just care about our investor. We care about the market. That's one of the reasons why we do this video. We have the podcast. So we want to provide as much information to help our clients, like we say before, to make better investment decisions. So in the future, is your retirement the most important asset that you might have. So we want to help in whatever we can add. I know this market is not, they're not easier, but we have a lot of people that we care. That's the most important part.
Well, thank you all for tuning in. We wish you a great start to the fall, and we will be happy to connect with you come the month of November. All the best.
Thank you.